At our company lately, we've heard a phrase frequently, which is good, as in good, as in no matter what someone says, good. And why would you say that? We're piggybacking off of Jocko Willink and a clip he has on YouTube where he says, whenever I get bad news, I always just say good. And he uses a lot of Navy SEAL language around it. But for us, it means, hey, recession's coming? Good. Hey, that deal didn't work out? Good. Uh-huh. Hey, investor passed on this one? Good. Yep. And why would you do that? The answer is you could start with bad, or you could start with saying, okay, I'm going to look for the positive attributes of why this thing is good.
And turn it into a positive.
Recession's coming? Good. Okay, we're going to learn, we're going to see new opportunities that came out that weren't happening already. Recession's coming? Oh, good. Well, we've been living at the top of the market for a year or two. It's time to get more value. Yeah. Investor passed on a deal? Good. We're learning more about how we should reframe our future deals so they better fit what the market wants. And for anything, there's a good piece to it.
Yeah, and we really try to build that resiliency into the organization. Yeah, because we throughout the organization, we're going to be confronted with challenges, issues, problems, and the more resilient our organization can be, the more resilient each individual can be, the better we are as an organization. Yeah, companies don't thrive and grow in good times. They thrive and grow in bad times. Good times hide inefficiency. They hide problems. And it's the bad times that really kind of bring out the best in people.
Success is a lousy teacher. Yes. When you experience success, it reinforces how you already perceive the world. I believe we are great investors. Yes. Success happens. Well, of course we are. Yes. But difficulty is where you're honed. Difficulty is where your assumptions about yourself or your firm, your teams are chipped away, and you are left looking at the bare, brutal facts, as Jim Collins says, and you must confront them. So, brutal facts, good. Difficulty, chipped away, good. How can we bring this into our process, into our team?
Yeah, I think of a couple examples. First of all, I remember vividly as we were actually in an offsite meeting together when the governor locked down the state of California for COVID, and every state ultimately was locked down as well. And that was when we were fully confronted with the reality of this completely unexpected situation, which also underscores, by the way, that you can engineer and anticipate as much as possible, but there will always be scenarios outside of your expectations. And it's how you deal with that. And I remember we kind of created a war room in this conference room, and we sat down and looked property by property,
loan by loan, occupancy rate by occupancy rate,
tenant by tenant, and really drilled down into what could this mean, with our portfolio, what sort of impact. And it was you're taking a situation that clearly creates distress and problems, and being able to say, good. Mm-hmm. How do we build resilience out of this exercise, and what can we do in our portfolio that is going to make us more and more resilient coming out of this?
There's that great quote that history is the study of surprises. If everything went according to plan, it wouldn't be the important part. It's those surprises that happen all the time, but certainly every few years, those curveballs that make and break companies, and our ability to not just know how to react to surprises, but to have the character and to have the team and to have the ability to be hit with a surprise and have enough dry powder, enough debt runway, enough diversification, enough years of experience, enough courage and passion and strength to take that surprise and say, good. I don't know why it's good. Why is it good? Let's think of some reasons why it's good. Okay.
What are we going to learn out of this?
What are we going to do with this good? And our company has generally thrived on disruption. The bigger, long-term companies are less looking for disruption and more looking for status quo.
Yeah.
When disruption happens, we're able to nimbly work plans that work around those and to create opportunity.
Yeah, I think a good example is our Fund 1 portfolio is effectively 4 office buildings and 1 small industrial property. That was all purchased pre-COVID in 2019 and 2020. And talk about an opportunity to say, good. And here we stand today. I just number one, the portfolio as a whole has performed well above what one would have expected post-COVID. Certainly not what we would have liked, pre-COVID. But COVID is an externality. How do we deal with that? How do we respond to that? But a good example is 1651 Response Road.
Yeah,
and this is a property where we bought it 35% occupied.
Yeah.
Office building.
With short-term leases.
At
$76 a square foot, which is a screaming deal.
Yes. In just pre-COVID.
Yeah.
And
probably
today,
a quarter of replacement cost.
Yes. And we learned through that. Yeah, I mean, that was an absolute learning opportunity. So, for example, not surprisingly, the leasing took longer than we expected because COVID hit. Nobody's touring and nobody's moving. And so the lease up time took longer than we expected. Then add to that.
About a year longer.
Yeah, add to that inflation in construction costs. So meanwhile, we're dealing with an asset that is getting pretty substantially gutted and renovated and having escalated construction costs along the way. And of course, fast forward to today, we now have a fully stabilized building at market occupancy. We have a cash flowing asset. And I think that certainly speaks to our team and our ability to select good investments, even in the midst of COVID.
The leases we got done during that time were heroic.
Yeah.
Heroic. They were incredible. We hustled around it.
Yeah.
But here's a good piece of that.
Yeah.
We learned buying office buildings in great locations at $76 a foot that are 35% occupied is a hard way to make money.
Yes. And it has a lot of risks.
Yeah.
When you move on that spectrum, it moves closer to development than to, buying a stabilized value add property.
We don't buy many office buildings now.
Yeah.
But the most recent office building we bought was about 86% occupied at $120 a foot.
Yeah.
Still a very low basis. Still probably a third or 40% of replacement cost. But much higher occupied with smaller tenants that are easier to replace versus the other one, which was really cheap, but big tenants and difficult to replace. But we got the leasing. We're in the mid-80s now on 1651 Response. And our rents...
On the occupancy.
On occupancy. And our rents are either higher or at where we modeled. So it took a year to a year and a half longer than we thought, but we're cash flowing.
And we also, another thing we learned out of that was, as you alluded to, we have a preference for highly multi-tenant buildings instead of large floor plate tenancies, because large floor plate tenancies, they represent more risk on lease turnover. They also represent more cost should they go vacant. And since that time, we've also modified our preferences around that. And you look today, and primarily multi-tenant industrial, multifamily. These are moves that came out of hardship, out of a good situation where we had to look at what we're doing differently.
During that good piece, we moved from, I think, how we were sort of raised in investing, which was more of a local look, to more of a institutional scaled approach to investing. Mm-hmm. I think prior to that, certainly we were mostly office, and we were thinking, all right, how are we going to reposition this asset? What are we going to do with this tenant and that tenant? Definitely post-COVID, we're coming out, and everything we've bought has been scalable, meaning much more highly multi-tenant, much smaller tenant size on average. There's no one tenant that can sink us in the buildings we bought. Yeah. We refresh the buildings, we bring the rents to market, but these are all things that can be done over and over and over again and don't require highly selective conditions.
Yeah.
A great thing about the idea of good, and thank you, Jocko, for that, is in team culture. When you've got 53 employees, as we do currently, and you've got lots of teams throughout the organization, I think it's really important that we train them to approach from good. We are in the business of organizing chaos. If there wasn't chaotic forces in the world, we wouldn't be needed. Mm-hmm. We take properties that are dysfunctional, we bring them to functional, but in the midst of disrupting the norms on those properties, there's a lot of pushback. There's a lot of status quo that tries to say, well, it's always been this way, and tries to block what we're doing. So good is important, and we want our teams to start with good, because every day someone's going to throw a punch, or every day something's going to happen. Not throw a literal punch, but I mean something's going to enter the organization that's going to be block things. Okay, good. What are we going to do with that now?
Yeah, and some organizations have much more of a CYA approach, which is like manage your own turf, don't stick your neck out, don't take risks. And we believe that is absolutely contrary to a healthy investing environment. And so we try to inspire our team members to be okay with taking measured risks, to be okay with being confronted with a problem and how do you address that problem, because resilience is perhaps one of the most important traits that an investment company can have, because we cannot control our environment. We can simply respond to it, anticipate it, and correct for that.
Thank you for listening to Durable Value, an investor's podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit graceadapartners.com, where you'll find more information, investors' tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.